about the demand. I think it's the demand pull inflation, especially given the pandemic, this pent up demand that occurred in the supply chain. Talk kind of how those factors really, impacted this inflation rate, if you could.
Sure, and I'll probably take a step back. You reference a key point is inflation demand pull, or what we call cost push. In the 1970s, it was cost push. It was high commodity prices, oil, that really pushed through to higher inflation. We now, in today's economy, the energy intensity or usage here in the United States is only about 40% of what it was in the 70s. So energy is a much smaller impact in the economy, and therefore not going to be a big driver longer term of inflation. Really what we saw was a demand pull, very strong demand. And you think about the pandemic, hospitality, leisure really hit hard, but the rest of the economy, after just a short distraction, began with business as usual. So a good part of the economy really wasn't impacted. That's not to diminish the impact on some of those sectors, but large portions of the economy came away unscathed. At the same time, you had record government stimulus, you had the Fed slash interest rates. All of that money ended up boosting consumer savings. So there was this strong demand component. And during the pandemic, you couldn't really spend on certain things. So that those savings stuck around and has led to very strong demand. The other aspect, and there's two more components. One is the supply shortages. As we tried to reopen the economy, that led to higher prices. And the labor force really hasn't grown. In the US, immigration has been really fallen off. Part of that is due to the pandemic. Part of that's also due to government policies. And we just don't have enough workers. So all of that's leading to higher wages, which is fueling that higher demand, creating that inflation. So it's a complex issue that is getting better. Those supply shortages are coming off from the data that we follow. But yes, this is going to persist, Brian.
So, Anthony, that was great. So now we're probably going to further complicate the point or the subject of inflation, and we'll talk about systemic and some of the tools that are at the Federal Reserve's, in their tool belt to handle this. And just for listeners, when we talk about the Federal Reserve, their two mandated objectives are to, I think, maintain employment and maintain price stability, which that's the subject of really our discussion today, inflation. So if you would talk a little bit about how you see the Fed's role. Again, we're coming out of a period where we had unprecedented spending to address the coronavirus, COVID, and its impact on the economy. But also we've been in this long period of quantitative easing, which I know, again, I don't want to get too complicated, but it's important, I think, as in the Fed's role in inflation. So with that, systemic, love to hear your thoughts on this.
Yeah, on the Fed's role, they are a little late to the party, and have to take that with a grain of salt. The Fed wanted to do everything in its power to support the economy and bring it back from COVID. The response was tremendous. They did what they should have done. I think you have to give them many kudos in that regard. And in 2021, just slow to recognize that inflation was going to be persistent. And through the first part of 2022, it was still buying bonds to help keep rates low, which is really amazing when you think about it, despite the talk of an interest rate hike coming. So in the first quarter, we should see the first interest rate hike. The Fed's expected to raise rates a few times throughout 2022, 4 to 5 times, let's just say. That could change. But that is the primary mechanism by which they will try to slow down inflation, raise interest costs slightly so it makes it harder for consumers to finance things, and help at the margin ease those pressures. I think part of this is also beyond the Fed's control. They don't have an impact on certain commodity prices. Those are spurred by some other factors, and therefore some things are out of their control. To your point about quantitative easing, they are also expected to finish their bond purchases in the first quarter, and then it's anticipated they'll begin to actually just let those mature and roll off in June. Now, we still don't have details on that, but over time, as they don't buy bonds, it'll be interesting to see if that also has an upward pressure on interest rates, which would also serve to slow the economy and bring inflation back down. So those are the two ways the Fed can influence or at least try to slow down and control inflation.